Hello, students. Hope you are all doing good. And if you have not referred our previous video that is on the concept 1, please do watch it. So, Dhritarashtra and company we have solved it. And in this video, we have tried solving concept number 2, Ganesh Textile. Let us meet Ganesh in this case as a textile businessman who is extraordinary and unwitting hero in the ultimate journey journal entry, where employee steals goods and customers bounces check and furniture suppliers become very generous. So let us dive into this particular problem, concept number 2. Please refer our academy study material, concept number 2, wherein the Ganesh wherein we have to journalize the transactions for the month of April 2020. Let us begin with transaction number 1. On 5th April 2020, employees had taken stock worth 10,000 rupees, wherein the cost price is 7,500 on the eve of festival, and the same was deducted from their salaries in the subsequent month. In this case, students, the employees have taken stock against their salaries. The cost you have to consider here, because it is what the Ganesh has actually paid when he is purchasing, isn't it? So we should not consider sales price here. So the two accounts involved here are the salaries and the purchases. The salaries being expenditure which is increasing, and purchases relating to goods which is decreasing. Please note, salaries is an indirect expenses, whereas purchases is a direct expenses. One expense is increasing and another expenses is decreasing. So the journal entry here will be salaries account debited to purchase account. Moving on to the transaction number 2. In this case, Sahadev, a customer who has given check to us, has been dishonored. On 10th April, the check received from customer Sahadev has been dishonored. His check has been bounced harder than a basketball, isn't it? When a check dishonors, we basically reverse the original entry. This is like when your friend promises to pay you back, but his credit card gets declined. Suddenly, your friend owes you again, isn't it? So, in this case, the two accounts involved here are Sahadev and bank. Sahadev being an asset, it is increasing because he owes you back, right? So again it will increase. So you have to debit. Whereas bank account, because unfortunately in previous case it was debited, now it is dishonored, we have to credit back again because it is decreasing. So the journal entry will be Sahadev account debited to bank account. Moving on to the transaction number 3, 12th April 2020, the income tax liability of the Ganesh, proprietor, 1700 was paid out of cash. Students, please note, income tax of a proprietor is a personal expense and not a business expense. So it becomes a drawing. So two accounts involved here are the capital account and the cash account. So the capital is decreasing, you have to debit, whereas cash is going out of the business, it is again decreasing, you have to credit. So the journal entry will be drawings account debited to cash account. Drawings are like when you borrow money from your business for personal purpose, isn't it? So moving on to the next transaction, wherein Arjun sell goods to us at 2000 but gives a 10% trade discount, which is 200, and a 50 rupees cash discount for quick payment. Students, trade discounts are not to be accounted in the books of accounts. Only cash discounts get the VIP treatment. So in this case, the three accounts involved here are purchase account, the discount received account, the cash account. So purchases is an expenses increasing, you have to debit. The discount which you are getting in the form of cash discount is an income, you should credit. Whereas the cash is going out of the asset block, that is from the books of accounts, you have to credit. So the journal entry will be purchase account debited to discount received to cash. Here 1800 should be considered as the base price now, and the 50 rupees discount to be considered as income, and balance 1750 has to be considered as cash outflow. So the journal entry will be purchase account debit to discount received to cash account. Moving on to the next transaction, 15th April, cloths distributed on sample basis. Think of it as a paying for advertising, but instead of name board, you are using actual products. The purchase account is saying like, well, those clothes are gone forever. Students, two accounts involved here are the sales promotion and purchases. Sales promotion is an expenditure which is increasing, you have to debit. Purchase, being the goods is going out, purchase expenses will decrease, you have to credit. Both the accounts here are in the nature of expenditure, but sales promotion being an indirect expense and purchase being an direct expense. So one expense is increasing and another expense is decreasing. So the journal entry will be sales promotion account debited to purchase account. Moving on to the next transaction, 16th April, Abhimanyu, a customer from whom 1000 rupees was due, became insolvent and could only pay 25 paise in a rupee. Poor Abhimanyu owes us 1000 rupees, but he can only pay 25 paise per rupee due to insolvency. Students, understand, in this case, he could be able to pay only 250 rupees and 750 rupees becomes bad debt. This is basically an accounting equivalent of something is better than nothing. We have to take what we can get and write it off, the rest as a lesson in choosing customers wisely, isn't it? So the accounts involved here are the cash account, bad debts account and Abhimanyu account. So cash account being an asset which is increasing, you have to debit. Bad debts being an expense or loss increasing, you have to debit. Whereas Abhimanyu being an asset, it is decreasing, you have to credit. So the journal entry will be cash account debit, bad debts account debit to Abhimanyu account. Moving on to the next transaction, on 18th April, furniture was purchased from Jio Sales 2 lakh rupees by issuing check. Two accounts involved here are the furniture and the bank account. Students, please remember, if the name of the party is given as well as the payment mode, whether cash or check, in such case you should treat it as payment through check. If the payment mode, either cash or check, is not given, then should be treated as credit purchases. So here, since it is check is given, so the two accounts involved here are the furniture and bank account. So furniture being an asset which is increasing, you have to debit, whereas bank account will decrease, being an asset, you have to credit. The journal entry will be the furniture account debited to bank account. Moving on to the next transaction, freight charges of 1000 rupees on purchase of furniture was paid by supplier on Ganesh's behalf. Students, this is actually in connection with the purchase of furniture which we have done in the previous transaction. So in this case, the two accounts involved here are the furniture account and the Jio Sales account. Please remember, the historical cost concept states that you have to capitalize all the expenses until the asset is ready to use. So this freight charges, which is in connection with the purchase of furniture, is a capital expenditure and not a revenue expenditure. please don't get confused and classify as revenue. This is a capital expenditure and you should add it to that asset which you are purchasing previously. So the two accounts involved here are the furniture and geo sales. Here we have to credit geo sales because the supplier has paid on our behalf, isn't it? So we have to credit geo sales. So the two accounts involved here are the furniture and geo sales. Furniture is being an asset which is increasing, you have to debit, and wherein the geo sales has paid on our behalf, we owe them. It is a liability which is increasing, we have to credit. So the journal entry will be furniture account debited to geo sales account. Moving on to the next transaction, number 8, that is on 20th April, 1000 rupees was received from Amar in full settlement against amount due 1100 rupees. Students, please remember, when the term full settlement is used, it means there are no dues left in that particular account. So it means whole and soul, the party has settled the account. So in this case, when 1100 was due and he is settling 1000 rupees, the difference 100 rupees is considered as discount allowed. So the accounts involved here are the cash account, discount allowed account, and the party Amar account. So cash is an asset which is increasing, you have to debit. Discount allowed being an expenditure, you have to debit when it is increasing, and the party Amar is an asset which is decreasing, you have to credit. So the journal entry will be cash account debit, discount allowed account debit to Amar account. Moving on to the next transaction, on 29th April 2020, salary to employees were due. One senior salesman and junior salesman salaries were due for the current month. Two accounts involved here are salary account and outstanding salary account. Considering the accrual concept, whether you pay it or don't pay it, considering the occurrence of the transaction, you have to account it. So irrespective of whether paid or not, you have to record this as a expenses, as well as you have to recognize the liability because it is due towards employees. So the two accounts involved here are salary account, which is increasing, the expenditure you have to debit, whereas outstanding salary is a liability which is increasing, you have to credit. So the journal entry will be salaries account debited to outstanding salary account. And the last transaction, 30th April 2020, we have purchased motor vehicle worth 7 lakh rupees from Shantanu Motors by making down payment of 1 lakh rupees by check and balance by taking vehicle loan. Students, this is like purchasing an asset by paying some cash upfront and by promising to pay the rest later. So the vehicle is yours, but so is the debt. So in this case, the accounts involved here are motor vehicle account, bank account since check is involved, and vehicle loan account. So vehicle is an asset which is increasing, you have to debit. Bank, you are issuing check which is decreasing, you have to credit, asset is decreasing. Whereas vehicle loan is a liability which is increasing, you have to credit. So this is how Ganesh survived the wildest month in the textile business history. So remember, journal entries are just stories told in the accounting language. Once you start thinking of them as conversation between accounts, you will never struggle again. Students, keep practicing and we will explore in our next video concept number 3 as to how the transactions dance their way for journal entries. So until then, may your debit always equal to credit and may your checks never bounce. Thank you.